name's Martin Conlon. I am the Head of Equities at Schroders, and today I'll be giving you a brief update on how we're seeing Australian equity markets, the positioning of the Schroders Australian Equity Fund, and the things that we think are important to think about when you're looking at your portfolio structure. I'm going to start by looking at what's happened over recent months and to give you our perspective. And I say this lightly because in these days where systematic investing and passive investing are so dominant in the setting of prices in funds, I think in markets it's very important to keep in perspective that traditional active managers probably aren't the price setters in funds, and our take on life is not necessarily the primary driver of what's happening in markets. Nevertheless, I think it's important when you're looking at equity markets to consider this slide here, because probably we have been surprised at how strongly equity markets have performed, both in Australia and the US and most of around the world. Why? This equity yield bond yield chart I think is interesting in the context of equities have undoubtedly been repriced versus bonds, and one of the main reasons in my perspective is that people are losing a little bit of trust in governments. There's not much sign of them getting government deficits and spending under control, and the whole nature of government bonds as risk-free assets in the future is probably being challenged. That's meaning that people are probably looking for safety more in equity markets than perhaps they have in the past, and as they take money out of bond markets, a lot of that obviously has to be directed into the big liquid markets, asset markets of the world, and equity markets is obviously a main contender on that front. When it comes to Australia, again, I'd be lying if I'd say we are not a bit perplexed at what's driven markets in the last couple of years, and this chart really explains why. The financial sector in Australia, A, is really big, but B, it has been the driver of equity market performance, particularly CBA, over the last couple of years, and that I think surprised everyone. Why has it surprised everyone? Mainly because CBA doesn't have a lot of revenue growth. It hasn't had much in the way of earnings growth. Yes, bad debts are benign in Australia, but to reprice a stock to the extent that CBA has, where it's now 12% of the benchmark in Australia, has really caught us and most other fund managers unaware. On the other side of the spectrum, you can see that materials and energy and resource stocks have been the laggards in the last couple of years. Again, that's the other big sector of your money in Australia, so that as a weighting in the benchmark has come down, and really the headwind, particularly for our performance, has been the respective weights in those sectors. So we continue to see quite a lot of value in the resource sector, and we see financials, particularly CBA, as being very overpriced, and I'll go into why. The rest of the market, and industrials obviously is the generic term which captures a lot of that, is really about some segments, particularly the tech sector, which in both the US and Australia again has been the sector to shoot the lights out. But outside the tech sector, most of the industrials have experienced relatively anemic performance. Yes, there are some winners and losers, but it has still been trounced by the financial sector. So that's been the story of markets in recent months and recent years. The last quarter was no different. We think that's got some very interesting implications when it comes to how you set up your portfolios in the future, and I'll go on to touch on why. Our positioning and the fund performance has really been driven by the sector positioning, and dominantly our sector positioning in financials. You can see here on this chart where the best part of 10% underweight in the financial sector. That is now huge in the context of the Australian market at 35% weight in financials. That that sector weight looks crazily out of line with, in our view, number one, the importance of the sector to the economy, but number two, most other stock markets in the world. It's just crazy to have so much of the economy driven by the financial sector and so much of the profitability of Australia coming out of that sector. So that is the big underweight. It's been costly in the past. We are very optimistic that it will be a significant contributor to portfolio performance in the future. At the other end of the spectrum, you can see that our other big underweights are in sectors like information technology. That really stems from valuation, where the crazy valuations accorded to the tech sector mean that any valuation disciplined investor like us is really struggling to justify many of the positions in this sector. They are all trading on revenue multiples. Their PE multiples are all 50, 100, crazy multiples in the context of history, and multiples where having bought those stocks at that price in the past, most times you will lose money in the longer run, and we think the same will be true again. Where's the good news? Well, again, the overweight positions in the portfolio really are across a range of sectors which give you a lot of economic diversity in the portfolio. So we'd maintain that the economic diversity in the Schroders portfolio is far better than that of the benchmark. That overweight I talked about in financials and the overexposure to those profit streams means that you can have a better economically diversified portfolio than the benchmark. Materials, again, Australia is a big player in resources around the world, and those stocks have generally been poor in the last couple of years, which means in a lot of cases you're getting the opportunity to buy those stocks at pretty attractive valuations. The rest of the portfolio, you can see again some shifts over recent months, and things like healthcare, where that sector has been under pressure for a lot of the last year or two. We're seeing a lot more valuation appeal in stocks like that. That's moving up in terms of positioning in the portfolio, but broadly we've got valuations in the portfolio that, number one, are below the market averages, and in most cases significantly so. So both the dividend yield and the price earnings ratio of the portfolio are well below what you're seeing in market averages for, again, those reasons I talked about, where in general valuations of equities around the world are moving to very high levels versus history. So it's the time to be cautious. It's the time to worry about downside protection rather than to be greedy. Just to highlight where we think the market's going and why, what I've done today is just pick a couple of stocks to really highlight the extremes of market valuation in Australia. The first one is CBA, and again, you're probably sick of hearing about it given how much attention it gets in the news for the reasons and that inexorable rise that we've seen over recent years. But bringing it back to fundamentals, I think, is always a good way to look at every business. What are you doing when you're buying CBA? And the chart on the right really highlights and breaks down CBA's profit picture. We always look at businesses on an economic value added approach. So what we're doing is saying, what returns can a business get? How do they compare with those that the average equity investor demands? And therefore, if they're good, how much can we expect those returns to prevail in the future, and how much are we willing to pay for the business given those prospects? To put some numbers around that for CBA, CBA's book value of its equity now is about $75 billion. So let's say I'm a normal equity investor and I want a return of about 8%. I would need about $6 billion of net profit after tax from CBA to give me that sort of return on the book value. The good news is CBA makes more than that. As a well-managed bank with a very strong market position that's able to get better returns than the average bank in Australia, it makes about a 13% return on equity. What does that mean? Well, in dollars, that means it's making about $4 billion on that book value, $4 billion more than you need to justify your 8% return. The bad news is on the left-hand chart. Why do I say that? Well, current equity investors in CBA are paying more than $300 billion for its equity. So 4 times book value. That is a crazy price for a bank in the scheme of most of history, and it's by far the highest price of any bank in the world. Similar banks like a 𝗝𝘂, where actually they make better return on equity than CBA, are trading at vastly lower valuations and PE ratios around the world. Again, condensing that to numbers, because you're paying about $230 billion more than the book value of CBA, the number of years that it needs to make that 13% return for you to get back to your to book value is about 60 years. That long period of excess return is just, in our view, improbable. And even if that does happen, you will only get an 8% return on your money. What am I saying? When people talk to you about the risk of being underweight CBA, we would look at it exactly the opposite way. The risks of having 12% of your portfolio in CBA at the moment are crazily high, and in the long run, we see the odds of you even making money from the current share price in CBA as very low. That is exactly why in our portfolio positioning we've got the significant underweight to financials that we do. At the other end of the spectrum, I'm going to choose one where Fortescue is a business that we haven't actually owned in the portfolio for a long time, but we were discussing it a week or two ago, and to me it brought to light some really interesting numbers. Why? If you think about what you're doing when you're buying Fortescue, you're currently paying about $30 billion for the equity in Fortescue, and it doesn't have much debt. It's got a couple of $1 billion of debt. So you get to buy the whole enterprise, if you like, for not much more than that $30 billion. In return for that, and again, being very simple about it, they produce about 190 million tonnes of iron ore a year. This chart shows you the history of how much they've earned on a per tonne basis through all of their history, and you can see that it's over that 15-year type history, they've made nearly $40 a tonne on average. So the 200 million tonnes or thereabouts would actually give you about $8 billion a year of operating profit through that history. Our forecasts that we see that iron ore prices will roll off materially, and they will only make about $15 a tonne on average in the future. So we're envisaging much tougher conditions, but even at that $15 a tonne profit, 200 million tonnes of ore will give you nearly $3 billion of profit. So you're only paying about 10 times EBIT or operating profit for that $15 a tonne profit, encompassing that significant roll-off we're envisaging. When I compare that to the CBA return that I just talked about, a 10% return for a very sustainable, long-dated profit stream, Fortescue is still a good iron ore operator. That 10% return for Fortescue and a whole lot of similar resource stocks, we think is pretty attractive versus what you're getting in the vast majority of the rest of the stock market. Going back to those 8% type numbers I talked about, our numbers would suggest that you're going to comfortably get that or better in a resource stock, in most resource stocks, even with more challenging conditions in the future. So that overall picture, a very polarised market, one that's still pretty expensive when you look at totality. But again, the important thing is underneath that, you're getting some extremes where you've got very aggressively valued like CBA, but a lot of resource stocks like Fortescue offering you pretty attractive valuation multiples and pretty attractive return prospects in the medium term. So an important time for sector positioning, an important time for stock selection, but one where we think you really need to be careful about chasing the stocks that have contributed a lot of the momentum and a lot of the portfolio returns of the past.